Hello everyone and welcome back to these sessions on derivatives. In this class of derivatives, we continue with our discussion on options arbitrage. In the previous class that was about options arbitrage part 1, I have explained to you how to determine delta or hedge ratio of an option, and of course prior to that you have already learned option valuation. So we took a particular example, that was example number 1 in this category, and we have found the value of call option in that particular example. What I remember, it was $6.82. So if you are watching this video without completing the first part, I would strongly recommend that please watch the first part first. This concept what we are discussing is very important. This is applicable for CA Final AFM, CMA Final SFM and CFA Level 2 candidates for derivative topic. Now when we are talking about arbitrage, means there is an arbitrage opportunity. So in the previous example, when we have observed the value of the option as $6.82, just imagine that the price at which this option is trading in the market is suppose $8, means the fair value of the option is $6.82 and the actual price of the option is $8. In that case, anyone can conclude that the option is overpriced. And what do you do when something is overpriced? You sell it, right? So you sell the option. When you sell the option, means you become option writer, means you take short on options. So because this is a case of call options, you go for short call, that is writing a call option. Now let us assume that the lot size in that option contract is 100 call options per contract. So you are going to sell 100 call options, or you are going to write 100 call options. But because it is arbitrage, something you are selling, against that something you will have to buy. So what you are going to sell is options. So against that what you should buy should be the shares, which is the underlying. Now how many shares you should buy when you have 100 call options to sell? That is where the hedge ratio comes into picture, or delta of an option comes into picture. So you are going to buy 50 shares, because in our earlier example we have computed the value of hedge ratio or delta as 0.5. So 0.5 of 100 will give you 50. So against the strategy where you are selling 100 call options, you parallelly buy 50 shares, and that will complete your arbitrage. How would you earn arbitrage profit out of that? I am going to explain to you in detail. And for this purpose, let me also cover up an example which will be continuation of example 1. So I am putting this as example 2, where the entire data given from beginning till end is resembling the same data which was given to you under example 1. All this is same. Additional information what you get over here is this: the call option is trading now at $8 with a lot size of 100 options per contract. What will be the hedge ratio? Explain how this opportunity can be exploited to earn an arbitrage profit. Now this is the example that we are talking about. So now let us look into how to present the solution for the same. In your solution, you are going to first explain, given the up and down factors, the stock price would be $60 and $40 in the up and down states respectively in 1 year. The call payoffs would be accordingly $10 and 0 in up and down states respectively. We have already dealt with this part earlier. Option is trading at $8, whereas its fair value is $6.82. Because the option is overpriced, we will sell 100 call options. Why 100? Because the lot size is 100 given in the example, and purchase a number of shares of stock determined by the hedge ratio. Hedge ratio is nothing but the delta of the option. So hedge ratio is 0.5 shares per option, and total number of shares to purchase will be 100 into 0.5, that gives you 50 shares. So please write up this much and then I take you ahead. Alright friends, once you have written this much, let us move ahead, and now we continue writing further. A portfolio that is long 50 shares of stock at $50 per share and short 100 calls at $8 per call has a net cost of. So first of all, you identify what will be your portfolio cost. So keep in mind what you are buying and what you are selling. So the net portfolio cost will be, see, 50 shares you are buying at $50 each. This is the spot price of the share. This is your cost at present, and then you are selling 100 call options where the option price is $8. So this value you are going to receive. So you know what you have to pay is 50 into 50, that will be $2,500, and what you have to receive is $800. So you will have to make a net investment of $1,700, that is $2,500 minus $800. Now this $1,700 you will arrange through the risk-free rate. In other words, you are going to borrow this money at the risk-free rate of 10% for a period of 1 year. Keep in mind one thing, an arbitrager will never put his or her money into the process of arbitrage, because it is the market money which you have to put in the market. So you have to make sure that if this net portfolio is coming up at a cost, you are going to basically borrow money to fund this. Now here I am giving you an important instruction which you should carefully understand. Just imagine in this similar kind of situation, what if the call option would have been underpriced? If the call option would have been underpriced, you would say that it is better to buy the options, and for creating an arbitrage you would sell the shares. But you are not going to sell the shares from your current existing lot of any other portfolio. Selling these shares over here would mean make a short sell. In that case, for making a short sell, you will have to borrow the stock. In this strategy, you are going to borrow money. In the other strategy, what I just explained, you would have to borrow stock. So you are going to borrow in one market and invest in another market. That is how arbitrage works. You know it very well. We have seen plenty of arbitrage situations earlier. So let us do one thing. Let us continue understanding what to be done for this purpose. In this example, you are going to arrange this $1,700 by borrowing at 10% per annum for 1 year. So we will borrow $1,700 at 10%, and then we'll have to repay the same amount with 10% interest. So $1,700 into 1.1, the future value of that with 10% risk-free interest rate becomes $1,870 by end of the year. So you will have to repay $1,870 by end of the year. However, the value of this portfolio at maturity, if the stock moves up to $60 or down to $40, are identical as explained below. Now that explanation I am just going to put forward on the screen in just a minute, but first you understand. Here again, my friends, please, if you haven't watched my videos on portfolio replication model, where I have explained the detailed logic behind why the portfolio values by end of the period will be same, that logic you should be very, very clear with. See, for me, there is no point in repeating that concept in every video. So it is a detailed explanation given logically over there where that understanding is needed. So in your exam, I can assure no one is going to ask you questions on portfolio replication model. But without that logic being cleared, you come and get stuck over here. and you don't know why it is happening like this, and there your learning becomes mechanical. So when many students ask me, sir, I don't have to do portfolio replication, right? Because you have provided video even for that. My curriculum, my syllabus does not have portfolio replication model. Then why should I touch that? I just tell them one thing: watch every video that I have given to you, so that you should not have any misunderstanding with respect to logics applied, or I would say, if not misunderstanding, you should not even have lack of understanding. Your concepts should be very, very clear, because what is to be done and how it is to be done, if you just prepare that, you are having rule-based preparation, right? If you also understand why we are doing all that, then your preparation is actually concept-based preparation, which I always emphasize. Anyway, right now let me give you an opportunity to write down this part, and what is explained below I am going to show you in the next slide, but first you write up this much quickly. Alright friends, once you have completed writing this whole thing, let us continue writing further in your solution. Portfolio value after up move. What will be your portfolio value after an up move? Means when you are talking about the higher probable price, what will be the value of your portfolio? Keep in mind one thing: in your portfolio you have short 100 call options and you have taken a long position on 50 shares. So your 50 shares which were bought at $50 each, that price has now increased to $60 per share. And on the other side, because it is an upward movement, your call option will also have a value, and here you are the writer of the call option. You have written this call option, you have sold this call option. So whatever be the payoff of that call option, you are not going to get that. You have to pay it from your pocket. But do not worry, you are eventually still going to make profit, because this is what we call as arbitrage. Whether the stock price move up or down, you will eventually make profits only. That's the beauty of the concept of arbitrage. So what is the value of your overall portfolio when the price moves up? Let us understand this equation that I have plotted over here. 50 shares, each having value of $60. That will be your wealth in hand. But what you will have to pay from your pocket is each option will have value of $10, because you are the writer of the option, you have sold the option. Counterparty who is holding the option will claim that much differential from you, right? That is, whatever be the value of that option, the counterparty will claim from you. Because you are option writer, you will have to make a payoff from your pocket. So it will be a negative cash flow or an outflow from your pocket. How much will be that outflow? That I mentioned that for 100 call options, the payoff will be, or the value will be $10 per option. As a result, 100 into 10 will be what? $1,000. And the value of share will be 50 shares into $60. That would be what? $3,000. So $3,000 is the wealth in your hand, and what you have to pay out of that from your pocket is $1,000 for settlement of your option contract. What remains in your hand is $2,000. Correct? The same thing will happen when it is the other way. That is, when the price moves down. When the price moves down, each share is quoted in the market at $40. That is LPP, the lower probable price. Correct? But you have 50 shares, each priced at $40. Total value of your portfolio becomes $2,000. And this time nobody is going to take away a single penny out of that. Why? Because the option is getting lapsed. The option does not have any value. So counterparty cannot come and exercise the option. In fact, if counterparty comes and exercises the option, you are going to make money out of that, right? But nobody will do that. You know it. So the value of your portfolio will still remain $2,000. That means you see one thing. Whatever happens to the stock price, whether it moves up or down, the value of your portfolio remains $2,000. Now you know, you have taken a loan, you have borrowed money, you have borrowed $1,700 at risk-free interest rate of 10% per annum for a period of 1 year. We have also found the maturity value of the same, which you have to repay with interest, that is $1,700 plus 10%, $1,870. That you have to pay, that is your obligation. But the wealth in your hand, the net wealth in your hand, under either scenarios, whether the stock price moves up or down, the wealth in your hand is $2,000. So $2,000 is the wealth in your hand, and $1,870 is your obligation. You pay it off, you still have a remainder value in your hand. That is your arbitrage gain. So let me show the calculations over here. So either case, the portfolio has a value of $2,000. Profit on the portfolio at end of 1 year in either state after repayment of loan will be $2,000 minus $1,870, that comes to $130. But keep in mind, this $130 you are going to receive when? After 1 year, correct? So what will be the present value of this arbitrage gain? If you want to determine, you again discount it using the risk-free interest rate of 10%. So $130 divided by 1.10 would give you $118.18. So please write up this whole thing, and that will be end of the solution.